So how does a UL policy works? Okay, I found this picture in the internet, but I thought it's very easy for us to visualize how this UL works. It's like a broiler. All right. So we start off the UL by deciding how much we want the coverage to be. So let's say $5 million policies, and what the first step is to decide how much premiums you want to pour into this boiler. Okay, typically there is a range, a minimum range and maximum range. You can decide whether is it a lump sum, is it a recurring premiums. So it's highly flexible. Next, before the funds get invested, there are some charges you can see on the tab on the left hand side. There are some tabs leakages. Okay, first leakage is premium charge. Typically about 7% of what you put in it's like a sales charge. Okay, the first cut for first cut, and then subsequently there's also a recurring cost to fund the face value charge. This is like fixed costs as well as cost of insurance. All right. Then after all this cost, there is the remaining premiums will be invested. For a traditional UL, it is invested in the non-par participating fund. Basically, it actually offers a guaranteed crediting rate, currently about 1.6% to 2%. All right, so this crediting rate is guaranteed to you on year by year. If the policy does well, you're also able to deliver excess interest into these policies. Currently, the typical crediting rate overall is about 3.5% to 4%. Okay, it has come down somewhat over the last couple of years. So this stage 3, 4, 5 will actually go round and round. It will just continue in this cycle until one day the person, the insured pass away, and then the insurance company will look into this cash value and assess how much the payout will be. However, in some situations whereby the cash value didn't grow as fast or is insufficient to cover the charges, what will happen is the insurance company will write to the policyholders to do a top-up of premiums. If you don't do a top-up premiums, what happens is that the sum assured will reduce or eventually goes into lapsation. There are some things you can do with these policies. Besides investing the premiums, you can actually do a withdrawal, or you can take a policy loan. And this policy loan is dependent on how much cash value is available for you to withdraw. One thing to note is that wherever policy loan is taken out, there is an interest that needs to be paid to the insurance company. So this is by and large how a traditional UL works. For different UL like index or variable UL, the 4 and 5 stages will be different. The segregated portfolio will be managed differently.